You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Last week, we went out and looked at a back spread, otherwise known as a volatility spread, in Costco. And that trade hasn't played out. Costco is about to announce earnings tomorrow, and today the trade is just basically sitting where it was. So we put the trade on, nothing has really happened, so we're going to let that one play out tomorrow. The underlying is within 50 cents of where we put it on. Let me just give it, just for sake, let's get a quote on Costco. Costco is currently trading at $233.20. It's down $3.15. So it did make a little bit of a move. That's about a 1% move. But it ends up that move just put it right where we were when we put the trade on. And the whole trade was based off of earnings anyways. So we're just going to wait for that. Well, we are taping Options Playbook Radio right now on Wednesday, October 3rd. The markets have closed. We're going to look at another earnings trade. So we're going to have two trades to talk about next week, and they're both going to be centered around earnings. Now we're getting into the FANG stocks earnings. Sure enough, they're not that far away. The first one, as always, is Netflix. Netflix is going to be announcing earnings on the 16th of October. So what I'm going to do is, to get ready for this trade, is a calendar spread on Netflix. So the concept of calendar spreads, and what I like to talk about on Options Playbook Radio, first of all, not meant to be a recommendation. They're just learning. We're looking at specific situational things that you might want to apply some of the option trades. And one of them is you have a high price stock around earnings. It has a lot of juice in it, and you anticipate that that contains the earnings, the implied volatility will increase, and the expiration that does not contain the earnings, the option contract that expires before earnings, implied volatility will decrease, and time decay will happen, as it always does in option trading. So flip a coin, once again, just like we did in Costco. Last week we were bearish in Costco, so I'm not even going to flip my coin. I'm just going to go bullish on Netflix. And we're going to look at a long calendar spread with calls. Today's call will be short and sweet, and next week we'll look at both of these trades and see where we're at. On the Netflix trades, I'm not intending to do this going into earnings. Like, I want to be out of this trade before that happens. And the Costco trade, we'll know tomorrow how it turned out. So here's the trade for this week. We have Netflix trading right now. NFLX is the symbol. It closed today at $377.05. It is down 9 cents, not even a dime. It's down 9 cents on the day. We have earnings on October 16th after the close. The expected move on earnings is almost 40 points. We'll call it 39 if we want to round up a little bit. And the implied volatility on the at the money option contracts right now is right around 59%. And we're going to look at the 400 strike. And the reason why I'm looking at the 400 strike, even though it's a 40-point move, which we're talking about 25 points away, is that what's more important to me is the first expiration in my calendar spread. The expiration that we're going to be selling is the week prior to that expiration announcement, and that is the October 12th expiration. 9 days remaining. The implied volatility on that at the money option contract is around 38%. And we're looking at, that means the expected move, if we buy the put, buy the call at the money, let's call it $19. Almost half, well, it is half, let's call it half, of what the next week expiration expected move is. So 20 points is feasible over that time. We're going to go about 20 points out, and I'm going to use a nice round number just so it's easy to enunciate. We're going to buy the 400 strike call, and that's going to be our strike line for our calendar. So the trade for this week is a short but sweet long calendar on a very pricey stock, just to lead us into the FANG stocks earnings, which are coming up shortly. So we're going to be looking to buy one of October 19th expiration, 400 strike calls, and we're going to sell one of the October 12th expiration, 400 strike calls. We're going to get this entire trade done for a net debit of $7.80 to the account. And our whole goal here is that Netflix will start creeping up towards that 400 level before that first expiration. And then we have a choice. We can either sell out the long calendar spread and try to take a profit, which we should have if we can get the market to stay somewhere below 400, but start creeping in that direction. 390, 395, that would be great. We would love that. And if not, well, then we can just remain long the call option if we want. At any point in time, we can just remain long that call option. Right now, is trading for at the midpoint $9.80. So we're taking $2 off of that time premium on that 400 strike call by selling that shorter term option contract. So I don't mind going into the Netflix earnings with basically a discounted call, if you will. So those are my two options as far as the trade is concerned. I'm putting this whole trade on. If it does go against me, I put it on for $7. I think I can easily make $2 if it goes in the right direction. If I lose $2 on this trade, I'm going to get out of this trade. I'll just close it. I put it on for $780 for every 1-by-1 calendar that we did, and I will take it off for $580 for every 1-by-1 calendar that I've done. Now, on the upside, as opposed to most calendars, you have a lot more upside if you can get the market to move in the right direction. Move up to the 400 level, because we have some delta in this underlying. We actually see that the delta of the 400 strike call is trading about 33. That would be our long option contract. And the delta of our 400 strike call that we sold is trading about 16. So we have some real delta here. Net delta overall is around 30 cents here on this trade. So for every point up, our net delta should make $30 overall. So we do have some potential upside. And that's why I like doing these type of calendars around earnings on high price stocks. Now, one thing about this trade compared to most of the paper trades that we do on Options Playbook Radio is because it's a high price stock, we're paying $780. That's some real money for every 1-by-1 spread. We usually don't look at spreads that are that expensive overall. And if you wanted to look at a trade, the next best thing, and you're worried about cost, is to look at an actual butterfly with that expiration in the shorter term month. But this is going to be the paper trade for the week, so let's recap. We have Netflix trading at $377.05. It's down 9 cents on the day. We know that the earnings are coming on the 16th. We're looking at the 400 strike call. Just because we were bearish last week in Costco, we chose to be bullish this week in Netflix. We're going to buy one 400 strike call with the October 19th expiration, and we're going to sell one 400 strike call with the October 12th expiration. We'll come back next week. We'll see where it's at, but we're looking to hopefully get out of this trade before we ride it into earnings. This isn't necessarily an earnings play, and we're going to have to manage our risk because we got some real capital to just put on a 1-by-1 spread. And that's going to be it. Episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.